Welcome to the Candlestick Forum session. Tonight we got Brad Powell, Right Angle Trading. He's got good stuff that adds to everybody's arsenal of techniques of how to make better profits in the markets. So without too much delay, Brad, I'll let you take it away, and we're very anxious to see what you got for us tonight.
Thank you, Steve. I want to thank Steve Bigelow, of course, Jim Cooper, Pat Johnson, all the gang at Candlestick Forum for having me back. I just want to say this is a great group of people to work with. I'm sure, as everybody in this room knows, they're very passionate about what they do, and Steve's so passionate. I attended it. He did a webinar for us last night, and I learned quite a bit from it. And, you know, continuing education and learning is really what helps us all continue to evolve as traders. So I'm thrilled to be here and thrilled to work at Candlestick Forum. As I always like to say at the beginning of one of my presentations, you know, obviously I'm here to promote right angle trading. Tonight's presentation, I have a ton of information in it that I am happy to share with people. I hope you find this information beneficial. And I want to please forgive me in advance if I suddenly have a pregnant pause and stop talking. It's because I'm reading a question. It's a terrible habit of mine. Let me start off by just giving you a super brief background on right angle trading. The company was founded in 2003 by Betty Crow. She was a former executive VP, financial advisor at a large Canadian brokerage firm, helped launch one of the biggest public offerings for one of the largest hedge funds, and 28-year market veteran. And what happened, quite literally, is she broke her shoulder and blew it out pretty bad. Was at home for several months on a leave of absence, was just trading, got kind of lonely, and decided, you know, I'm enjoying this a lot more than the brokerage business. So she founded the company, which is kind of why we both do what we do. Is I traded for many years alone. It's very stressful. You sit in front of a computer by yourself. And it's, you know, really enjoyable to be with other traders, work with other traders, because it helps us continually evolve. And I think it makes all of us better traders. I know it makes me a better trader when I'm working with other people and teaching them what we do. First futures trading program launched in 2003, several updates to it, and then got heavily into ETFs. Betty, the founder of the company, was one of the first people to really recognize, I think, that leveraged ETFs were going to take control of the market. And now, of course, they're 35% of daily market volume. So they've really become a mainstay of today's markets for trading. Betty is an avid technician, studying technical analysis, as am I. She studied with George Lane, the developer of the stochastic, Horst Mueller, who founded the Canadian Association of Technical Analysts, and has worked with him for many years. And my background is I kind of grew up in the stock market. My father happened to be president of retail for a very large firm. I started trading when I was about 13. Got back into it full time about 11 years ago, and have always been a student of technical analysis. And especially, you know, I'm always thrilled by the trend. So let's get going. And what I'm always trying to look for is the sweet spot of the trend. And I'll get a little more into that in a little bit. But we're looking at the TNA 5-minute chart, and we're looking at a 2-day period. This is the triple leverage Russell 2000 Bull ETF, and we're looking at a pretty easy to recognize, simple trend. The trends come in all kind of shape, sizes, durations, and they change quite a bit during the course of the day. So our goal is to find those sweet spots of the trend, and what I'm looking for is what we're looking for at Right Angle Trading. What I'm looking for as a trader is recognizing those really key pivot points that allow me to jump in with the trend. So we're looking at this trend over a 2-day period. It kind of we've been going down for a couple of days, blistered up as it often does, and then formed kind of a nice channel. And when we're looking at technical indicators, I want to introduce, some of you may be familiar with it, some of you may not. It's a term I've known for years and that I learned a lot about 5 years ago, working with our programmer on an automated future system. and with a professional statistician that we had brought in to help us do some work with genetic optimizing, and that's the concept of multicollinearity. If you don't know what it is, the definition is multicollinearity is a statistical term for the condition occurring when two or more of the independent variables in a regression equation are too closely correlated. Okay, let's translate that into plain, simple English as it applies to technical analysis. Two or more indicators are providing the exact same information about the market, confirming what you already know. All right, so when we look at different bits of information about the market, you can basically break it down into four categories. And, then there are some peripherals to that. For instance, Steve does candlestick analysis that you can add to it. And again, that's another way of getting information about the market. But when we're talking about technical indicators, apart from price, whatever your charts are as far as whether they're candlesticks or bar charts or whatever, you have momentum indicators, which are stochastics, RSI, CCI, rate of change, trend indicators, such as moving averages, MACD, DMI, ADX, average true range, volume indicators, which out of all of them, I kind of find, for me personally, don't give me a lot of information about the market because the volume changes, and it also has relatively consistent patterns. So OBV, shake and money flow, accumulation, distribution are examples of volume indicators. And then support and resistance, areas of support and resistance, which can be done with trend lines, Fibonacci levels, and price pivots. So when we get into technical analysis, our goal as traders, or my goal as a trader, is to garner as much information as I can about what the market is doing with as little clutter on my screen as possible. And speaking from a pure avoiding multicollinearity point of view, you would want to have at least one indicator from each of the four areas telling you something about the market. I'm not so sure you need all four, but what you don't want to do is get bogged down into using only one type of indicator to provide you with information about the market. So again, we're looking at a 2-day period of the TNA 5-minute ETF here. And most of our strategies focus on ETFs and futures because we think those are the two areas of the market where you get the highest rates of return, most bang for your buck. And, stocks, commodities, different futures markets, forex, whatever you want to apply it to. But the concept of multicollinearity is broad and kind of universal throughout the markets. So if I were to start developing a trading strategy in order to catch this trend, and try to catch these key price pivots in the trend to get long, avoid going short. And if I started developing a strategy with an RSI, a CCI, and fast stochastics, I would immediately be falling into the horrible trap of multicollinearity. Reason being, let's click back, all I'm doing is looking at momentum. I'm not letting the market give me any other information other than momentum, and that's only a very small part of the market, or only 25% of what the available information that I have regarding the market within technical analysis. So all I'm doing is looking at price and momentum. So this would fall, if you tried to build this as a trading system, you would have fallen into multicollinearity. And there's several issues with that. Now, I always have indicators, and in our courses, 2 momentum indicators. So certainly you can have more than one if you like to confirm, but don't get trapped in that pitfall of I'm only going to look at momentum because there's so much more information available in the market. When you do that, you have blinders on. And the other thing that happens is, let's just look at this quickly. So look at our RSI, look at our CCI, look at our fast stochastics. So let's say you were going to use regular divergence, higher high in price, and lower low in indicator to take short. Well, all 3 of these indicators have confirmed each other right here. You'd take a short. Let's say you were using hidden divergence, which I'm going to get into in a little bit, to go long. This is a hidden divergence signal, higher low in price with the trend, lower low in indicator, lower in indicator, lower low in indicator. So all 3 indicators have confirmed one another for a long here based on hidden divergence, but all three indicators have also confirmed one another for a short here based on regular divergence. So all they've done is confirm one another. They're not giving you any new information about the market. The only time I see a real difference in these, and this is one reason I do like to have two momentum indicators or two trend indicators, is sometimes they will provide you with different information, is right up here at this peak where there's no divergence here. The RSI is going higher, getting really incredibly overbought, whereas the CCI has a divergence in it and the fast stochastics are flat. So we do see different pieces of information, and that's another pitfall to multicollinearity. Now what do? I'm confused, so you have to stay out of the market because they're now giving you three different momentum indicators are giving you three different pieces of information. So if you're only looking at one area of the market, you're going to run into problems. And I was afraid that would happen, but Kayla will not be impressed if you fall into that multicollinearity trap. So, and I promise that's my only meme reference during the presentation. So I won't have an empty chair with Clint Eastwood pointing at it anytime soon. So let's get back to our basic trend. We were looking at 2 days, 5-minute TNA, triple leveraged ETF. And let's get in closer to the trend and just look at 1 day. Or I'm sorry, I got ahead of myself. So let's look at how we can identify key price pivots within this trend so that now I can add another level of information to my trading. And there's a number of things I've used over the years, one of which is basic trend lines. And the problem I have with trend lines on an intraday basis is the trend changes throughout the day, based sometimes just on lunch, based on when volume is heavy compared to when volume is light. And these are patterns that, as you'll see, repeat themselves over and over. So I don't want to get caught into thinking this downtrend is broken because it's fallen under the trend line and now have to look for another trend. So I think trend lines are, and of course this is my opinion, are incredibly very effective on 60-minute charts, on 2-hour charts, on daily charts. They can be very helpful tools. For intraday trading, the trend is changing too much during the day. You will fall into channels on a trend day. Trend days only happen about 20% of the market time, about 15 to 20% of the time. So you will fall into channels on trend days. But so I don't really find it very effective to draw trend lines during the day because I'm constantly having to redraw them as these new pivots are occurring. And I'm trying to save myself work and not get a cluttered chart. So again, what can I find to help me recognize these key price pivots? Something else I've used, I think they're very helpful in commodities, such as if you're trading oil, is floor trader pivots, price pivots. There's plenty of free pivot calculators on the internet. I think pricepivotcalculator.com is one where I created these that I use. So I entered the prior day's information, open, high, low, close, to get my points, and then drew them on to see how effective were they for this trend. Well, the mid one, it kind of blew right through it, so it didn't act as much resistance. It did act as support on the pullback. R1, it went right through, right up almost to R2, came back again, used the mid 2 as a support area. And then in the afternoon, the rest of this trend, it was really a very little help. So taking the open, high, low, close and applying it to the next day, where the pivot point calculator told me, these were, other than this 1 point here and resistance up here, these are pretty useless to me on the TNA. They may be a little more useful on the actual index themselves, such as on the futures, such as the S&P, or the YM, the Dow futures. They're very helpful in products that are heavily traded on the floor because floor traders do use them and they do watch these levels, such as CL, oil futures. But for day trading, I don't find these necessarily very useful. So something else that we do use that Betty actually is adamant about, again, the founder of Right Angle Trading, I use them sometimes. I try to be aware of them, is Fibonacci retracement levels. And Betty loves Fibonacci. One of the reasons why so many different traders across the world use Fib retraces that it becomes very much a self-fulfilling prophecy. So I drew this after the fact on day one from the low to the high. And you can see that virtually every pivot. Here was kind of in an empty space, but there was resistance at this fib retracement. Went through, and this is fib retracement. And then prior to the next day, drawing a Fibonacci projection using just the early morning low and the initial high of the day and project up. You can see it actually did a pretty good job of recognizing these key pivots, key areas of resistance. It misses some of them. On this day, it was pretty good, but we're in a very distinct channel on this second trading day. So, again, this is something we don't teach in our courses because a lot of charting platforms don't allow you to immediately put them on, but we will always work with clients if they're interested in Fibonacci because Betty, I've never known her to have a chart that didn't have some type of fib retracement or fib projections on them. We've, looked at GANFANs and Andrews Pitchfork. I don't really find those, again, overly effective for short-term intraday trading as much as I do like at Andrews Pitchfork. I think it's very beneficial in long-term trading off daily charts or weekly charts. I don't find it overly effective for short-term, 1, 3, 5-minute charts. So getting into what can I then use that is as little work as possible for me to recognize, because I want to be able to see something instantly on my chart and look at it and know that is providing me information about where these key pivots are. And what I use on a daily basis and what I'm seeing more and more that we teach in our courses, I'm seeing other courses. I take other courses just because I like to see what other people are doing, and I purchase other people's trading courses and attend webinars. And I just read an article a couple of days ago on a very popular trading blog for futures about a 20-period exponential moving average. And this is what we use in our courses, especially for futures, and now we're adapting it for ETFs to recognize where a key pivot in a trend occurs. So we're looking at this second day of the trend. In the morning, we expect a certain level of volatility as it turns back up and retakes the 20-period EMA. We see the kind of breakout, and the trend begins. And at every key pivot within this trend, all day long, we're really either quickly recapturing or pivoting right around the 20-period EMA. And we're going to look at a lot of different examples in different time frames and on different markets that will show how important this 20-period EMA can be. And again, I'm reading more and more about it, about more traders beginning to use a 20 exponential moving average to recognize these key pivots, because now it also provides an area of support and resistance for us in a downtrend resistance and an uptrend support. So I can get both trend information from it, and I can get support and resistance information from it. This is where I would expect support and resistance to be. So when I talk about the sweet spot of a trend, I have drawn up this rectangle is, to me, the sweet spot of this trend on this day. And that's because you stay out of the indecision in the early part of the day, you stay out of the profit taking in the late part of the day, and it's where the market is just trending consistently in the direction of your signal, hopefully, if you got a signal to go long. And there's really three sub-sweet spots that I'm going to talk about that I like as a trader because they're easy on our nerves and they're easy on us psychologically. And that's coming right off the 20-period EMA, coming right off the 20-period EMA, right off the 20-period EMA. And in each case, the trade immediately goes in the direction of our signal. And as we'll see in a minute, we get long signals on all of these setups. And that is so easy on us psychologically. I don't care if a trade loses. We're going to have losing trades. We all know that. Do I care? Yes, I don't mean I don't care. But I accept it. I accept it as part of trading. If a trade is going to lose, I hope and pray it loses within 5 or 10 minutes after entering, or if I'm trading futures, within a couple of minutes, because I don't want it to torture me. The reason I don't want it to torture me, I want it to go quickly in my direction, and that's one thing I love about trend trading, is the trade should pretty much go your direction very quickly, is you develop bad habits, bad psychological habits, bad trading habits. If it sits and takes its time to start going your direction and you're not able to start moving your stop up, and getting your stop up to break even pretty quickly, then it does a lot of psychological damage to you as a trader. And I believe that's when I tend to pick up bad habits. I start second-guessing my signals and start looking at something else and see, or just start overthinking it to the point of, I think I just better go out. This thing isn't going to go out. And inevitably, when you do that, it busts right up, and when you decide to stay with it, it eventually stops out. You know, it's always going to do the opposite of what you think. So I like these sub-sweet spots in this trend because you can trade in and out with the trend. You can stay out of consolidations that typically occur during lunch. 4 days out of 5, you're going to see the same pattern during lunch. And by lunch, I mean, 12:15ish to 1:15ish Eastern time. And in CME time, about the same, about noon to 1 CME time if you're trading futures. That tends to be where you see consolidation, congestion during lunch, and I don't take trades during lunch. Yes, Ted, there's nothing like waiting 60 minutes to finally exit a trade and make one tick and say, well, I covered my commission, right? So for me, there's 3 areas of this trend that I'm really interested in, and all 3 were identified by the 20-period EMA as an area of support, an area of support, an area of support, and a quick spring off that area of support. And now I'm going to move out to an 8-minute time frame. If you're only looking at one time frame, again, now you're falling into that multi-collinearity trap again. And as I said, this is going to be an ongoing theme. You have blinders on, and you're glued to the minutia in a shorter time frame. And for ETFs, we like 8-minute time frames. 3-minute can be a little too fast, a little too choppy in the leveraged ETFs. And, you get out to the 13 or 15-minute. I always keep a 15-minute chart up and look at it. But again, in the 8-minute time frame, it's like just sliding your chair back and getting a little bit more distant look at the market and taking in some additional information. And it's far enough away from the 5-minute that it's going to give you slightly different information, but it's close enough that they're not going to come into conflict with one another. I remember I took a trading course several years ago. 5 or 6 years ago. I want to tell you, if anybody ever has a question about a trading course, if it's any good or not, email me. I've probably taken every course out there. I love taking courses. I love learning what other people are doing, seeing if there's something I can add. And I took this one that was a very fast scalping course. Look at the 3 or 4 ticks, 2 or 3 tick stop loss. And it was using and this was before a couple of years ago, 3 years ago, they changed the way CME tick data was reported, and suddenly there was 3 times the number of ticks being reported as there used to be, because they used to lump a bunch of ticks together if they all came from the same server. If they all came from Rhythmic, then they'd lump all of those together as one tick at the same price. Well, they've split that up into true tick reporting. No, Steve, is this Esther? Yes, this is very relevant for Forex. Although, as I'll get to in a minute, in Forex, we actually find the 50, and I'll get to that EMA a little more important than the 20 EMA. The 20 EMA tends to be a little, Forex trades a little differently. And Brian, yes, I do trade range bars, and I'll get to that in a little bit. I'm actually going to show a chart. I traded range bars today. Steve, 5 and 8 are not EMAs. These are time frames, 5-minute and 8-minute time frames, and I've always got a 20-period EMA on there. And you can see, again, on the 8-minute time frame, where are we seeing these key price pivots? Right around the 20-period EMA. All right, so let's go to a shorter time frame. And we don't teach trading the 3-minute. We have clients who do it. We talk about it in our courses on ETFs. I don't really like the 3-minute. I think you get too many false signals. I like a little bit farther step back, except maybe during the summer when the volume's lower. But again, key price pivots are appearing or in a shorter time frame because more bars are being printed, the 50-period EMA. And so you can look at that area between the 20 EMA and the 50 EMA as an area of congestion and as an area of support. So you expect a little congestion when it's in there and consolidation, and then it springs back up and it recaptures it. And when we get into future stuff, and you know what, I'll be honest with you, I've never done this particular presentation before. This is the first time, so I'm not sure how long it's going to take. And I know I've got a lot of charts to look at. But again, in the 3-minute, now we want to add that 50 EMA and kind of keep it up as well. Now, for ETFs, for trend recognition, I love to always keep a 15-minute time frame up. I think that gives you a one-glance look at the market where you can look at it and say, I need to be long, I need to be short, or I need to stay the hell out right now. And again, here's a 15-minute, and I never look at a 3-minute on ETFs. I trade I always have 3-minute up on futures. You know, I have this tremendous luxury, and I want to throw a plug in here that I get nothing for. Believe me, I have a 6-monitor system that I got from Digital Tigers. They make absolutely fantastic. They make a lot of professional institutional traders trading systems. They're fantastic. There are other companies that do it as well. If you have one investment to make, if you are serious about trading and you have one investment to make, put it into a good multi-monitor setup for your computer. I don't know how people trade with one monitor. I really don't, because I have 6 monitors up now, and it was a little mind-boggling at first. Now I'm so used to it, and I've done it for years that I feel like I might as well be blind as not have my 6 monitors. So I have I always keep a 15-minute chart up of whatever I'm trading, because I think it gives you one glance. And on this particular trend day, you can, and obviously I picked a good trend day here to display these. We'll look at some not so good trend days later. But you can very clearly see the channel. You can very clearly see, now in a 15-minute time frame, a lot of times in a faster moving trend or a rolling trend, it's not going to make it down to the 20-period EMA. But as long as that's sloping up, and as long as these pivots are above it, I know that trend is continuing in my direction. And actually, another great one to use on longer time frame stuff is a 13-period EMA. Again, those fib numbers. I know Steve loves the 8-period EMA. And I'll show you my chart today. I actually threw an 8-period EMA after watching his webinar last night. But again, this just gives me kind of a broader look at the market. Lena, how I utilize each of the 6 monitors, I'll tell you. I keep up my primary dead right in the middle of me, my primary trading chart of whatever I'm trading that day, and I'm always trading futures. I'm a day trader. To the right, on my right monitor, I have my dome and my control center for Ninja. On my left monitor, I have my other, and this is my bottom row of 3, I have my other time frames that I might want to check for the tradable in the futures that I'm trading. I primarily trade the NQ. I love the NQ. I also sometimes, take a hit in the ES or take a trade in the ES. Some days I trade the TF. Right now I've been trading the NQ. I think you get to know one market very well and trade it very well. Then my upper 3 are for ETFs. This system, Alan, and it's not new. I mean, I've had this particular setup for 4 years. I'm still on XP. Actually, thank God. This is, I missed the whole Vista thing. I'm going to have to upgrade one of these days now, I guess, with Windows 7. But, it's about $5,000, which for the computer, the 6 monitors, everything all in was around $5,000. That was 4 years ago. It's probably cheaper now. All of my screens are 21 inches, so I have 6 21 inches. Okay, so back to the EMAs. This is still just always my 20 EMA. Here you might, on a longer term time frame, like 15-minute, you might want to throw up 13-period EMA, and on the shorter time frames, 3 minutes, 50-period EMA. But again, primarily I'm watching that 20-period EMA. So let's go back to just this day and look at some trade setups. And now we're going to take more into account. Okay, I've looked at my 15-minute chart. I've looked at my 8-minute chart. I kind of know what's going on there. And we come out of the day, and I'm going to look at some specific trades, and I'm going to use one momentum indicator. I'm using my 20-period EMA to recognize both where support and where support should be. Another indicator that we use, as opposed to the fib levels or channels or whatever, to recognize exit signals, and which I don't have on here. And down below, I've got a slow stochastic. Yeah. I'd prefer if you ask questions later. James, I didn't know that. TradeK offers big rebates on Digital Tiger systems. I didn't know they had a deal with them. I've never had a problem with this computer. A friend of mine recommended them. I bought them. I loved them. I don't participate in their affiliate. I don't get anything for plugging them. I thought they build really good systems. There are other companies that do as well. So it's good to know that TradeStation works with them as well. Okay, so this is a stochastic. This is a slow stochastic. It is only the percent K of the slow stochastic. and it's inputs, which is what we teach in our courses. I'm just going to tell you, 21 is the fib number, but I've tried 21, Greg, and it's just not quite as reactive as that 20. And again, I'm reading more and more traders and seeing more and more trading courses pick up on this 20 EMA. We've been using for years. I've been using it for years, and I'm seeing more and more people pick up on it. And things like that become more and more of a self-fulfilling prophecy because it does an amazing job. And I'm going to show you in any time frame, any intraday trading time frame, any shorter term time frame, it does an amazing job. Not so much when you get out to dailies or 60-minute or 90-minute. Then you get back to the more traditional techniques of the 20-period simple or 21 simple, the 50 simple, the 200 simple. No, Steve's slow stoke is 1233, mine's 533. 20-period SMA is the midline of Bollinger Bands. It's also the midline of the Keltner channel, Ted, in answer to your question. Okay, so let's look at this day. So we know we've had a trend going the day before. There's a high probability we're going to have a trend day because the day before was actually a reversal off a bottom. Quite often you get your trend days, which again only occur 15 to 20% of the time. You look for clues for these trend days. You don't always know you're in one until it's almost over, but there are clues to it. One is if you've come off a bottom reversal, there's a good chance the next day is going to be a trend day. If you continue a channel from the prior day, there's a good chance you're going to be in a trend day. You can make about 50% of your money for the year on those 15% of the days, on these trend days. All right, one of the things that we look for is what's called hidden divergence. And I don't know how much you know about hidden divergence, but I'm going to show you. Hidden divergence is when you have a higher low in price and a lower low in a momentum indicator. So people use it on the MACD, which is more of a trend indicator, and I've never really been able to make it work for my purposes with MACD. Works great with stochastics, works great with CCI. You cannot use them to confirm one another. I kind of like the CCI. I've always liked it as an indicator. I kind of always keep it on my charts or throw it on at least one chart. But the stochastic nails it better than any indicator I've ever seen. Betty has been using the stochastic for 25 years since she started, studying with George Lane. And I got to tell you, she has always said, if I could only have one indicator, and that's it would be a stochastic because it does a better job than any other indicator of really recognizing momentum and divergences. I agree. I agree entirely. So right here, we get a higher low in price. We're in this trend. We get a slightly lower low in our indicator. When it hooks up, it's right over the 20-period EMA. We go long. And right up here, we have an indicator we use to recognize exits. And as I learned last night from Steve, this would probably be an exit signal, too, from his candlestick analysis, that double doji and going red. You can get out right here and take your profit. Plus, we're getting ready to go into lunch. So I know the market is probably 9 times out of 10 going to consolidate. Hank, 533 on the stoke, on a slow stoke, and it's the percent K. Incidentally, the percent K of a slow stoke and the percent D of a fast stoke are the exact same thing. If anybody, there's another little piece of information. So it really doesn't matter which you use, just make sure you use the right percent line. So we get a long signal. We get long right here. Unfortunately, this trade kind of, takes a few minutes and then gets going. We get an exit signal. And then we get it again. Another hidden divergence with the trend. But it's too high over the 20-period EMA. And we're going into lunch. So I'm not going to take that trade. I'm going to wait until we're getting closer to the end of the lunch and see what happens. And so I'm going to show you what happens. And you will see this over and over and over and over during lunch when you have a trend day. Or even if you have a semi-decent trend day. ABC correction. This is also called a Gartley pattern, where you do your ABC correction with both of these lows staying over your prior low. Now, a Gartley normally is kind of like a butterfly pattern that occurs where you're using it for a trend reversal. But I see it during consolidations of trends over and over and over. And I'm going to, as I get going a little more quickly here, we're going to look at a lot of these Gartleys. Now, here's a trade that we invented, that Betty and I invented. And we saw it over and over again, and I named it a compound divergence. And I've never seen anybody else look at it, and I want to show it to you. And it happens with a Gartley pattern during a trend right at the 20-period EMA. you get this hidden divergence up over too high over your EMA to consider this a valid or a good, strong, firm level of support. I want these pivots right around my 20-period EMA, but I'm aware of this hidden divergence. I'm going into lunch. Now we get the Gartley, and we get a regular divergence coming out of lunch. This is kind of noise in here during the lunchtime chop, so I'm going to ignore it. So you have hidden, regular divergence, ABC correction, Gartley pattern, coming out of lunch, bam, go long. When this stochastic hooks up, we go long. That trade shoots right up in our direction, and we get an exit signal right here. Now we're waiting for a retracement, and what happens? Another hidden divergence. It signals very quickly right as we get in. We get in really low. Trade 1, 1%. Trade 2, 1.5%. Trade 3, 2%. If you can nail 5% on your IRA on 3 trades in a day and do that 1 out of 5 days, do the math. You're going to triple your IRA every year. And the reason I say IRA is because you can use the TZA when you get short signals. All right, let's look back for confirmation. I don't want blinders on, do I? I don't want blinders on. I don't want to fall into any multi-collinearity pitfalls. So let me go back for a sec. So I'm using this EMA is showing me the trend is continuing to go up most of the time. It will flatten out when we get these signals. My momentum indicator is giving this to me, and we have other indicators that we use for confirmation and to help us that are in our courses. But I'm just showing you a very simple, basic technique. Simple, stupid. I tell myself that every day. I have a plaque that says KISS because I tend to want to overcomplicate and overthink things. Keep it simple. I am getting support and resistance and trend information from my 20-period EMA. I'm getting my momentum information here, and I'm observing my trend from multiple time frames. I'm taking those blinders off and just sliding my chair back from my monitor. What am I seeing here? First thing in the morning, a hidden divergence signal to go long. Almost a hidden divergence signal when I got it off the 5-minute. So I'm taking my trade from the 5, but I'm aware of what the 8 is telling me. It came right off the 20 EMA. Made it easier to stay with the consolidation, watching that rising 20 EMA until it got up to the exit signal. Another hidden divergence off the 8-minute at the exact same time that I got my Gartley compound divergence off the 5-minute. Double confirmation, 5-minute and 8-minute. What happens when I get my last hidden divergence signal on the 5-minute? I have one on the 8-minute as well. I got in a lot earlier. I got in down here off the 5-minute, but I still got it off the 8-minute, and I saw that. I saw that it was setting up. So now I have multiple time frames confirming the same information over and over from 2 different indicators, 2 different types of indicators in 2 different time frames, and these are high probability trades. Are they all going to win? Absolutely not. I'm going to catch some losers. I'm usually going to catch a loser right at the end of the trend. Look, if I wanted to take a trade in the last 10 minutes, I could have made another 1% up here. But, you know, as a trend trader, I live for these trend days, and they make up for the horrible low volume choppy days like we saw the last 2 weeks of August. All right, so this chart is my 8-minute, and this chart was my 5-minute. All right, so let's get out of ETFs. That's one of our courses, the ETF Trader's Edge, where we teach ETF trading. ETF trading is fantastic. You can go long and short in your IRA. I trade ETFs, trade it in my IRA. Love trading ETFs. I haven't traded an individual stock in 2 years. Let's move in to futures, and let's see. Is 50-period EMA working again for us? And I'm sorry, I've got to find my notes. I just rambled on. I may have forgot something. Nope. Okay. So let's get in to the 3-minute ES time frame. Early in the morning. This is a totally different day, and this is not a trend day. This is a day where we had a trend reversal. Early in the day, my 20, my 50 are support right here, key pivot. I took a long right here and it lost, and it tortured me. I hate that. But that's the ES, and I'm going to say this now. The worst trending instrument in the markets, in my opinion, is the ES. And I'm going to tell you why. It's ugly. It has too many components weighing on it. Technology could be up, and the energy sector could be down, and leave the ES in the mud. Financials could be blazing up, but, healthcare could be down, leaving the ES stuck in the mud. The Dow up, the NASDAQ down. The ES perfectly flat all day. It is the worst trending market out there. Do I trade it? Yes. I don't particularly like trading it. I do trade it. We teach it in our course because you have to. You have to know how to trade the ES. That's where the liquidity is. Some other problems with it, the trends are ugly. They're just not as pretty as other markets, and we'll look at some other markets. 70% of the trading in the ES is algorithmic. You're trading against computerized systems that have 20 different strategies they can call on in the time you can look at one indicator. 20 different strategies based on split-second decisions on current market conditions. You can't trade, you can't compete with that. Large trades by institutions that may only be hedges. And I've seen institutional trades go off and just move it 4 or 5 points, and then it goes right back down because that big institutional hedge trade turned off. And what I just really don't like about it is it seems to torture you a lot. But, again, we see the 20-period EMA when a strong trend develops. So here had a losing trade and then a couple of winning trades with the new trend. Once again, where are our key pivots? Wow, 20-period EMA, pretty amazing. All right. Let's look at the 5-minute on that same day. Again, right close to the 20-period EMA, key pivots confirming. I like to use the 3 and a 5-minute. I actually don't really trade that much of time frames anymore. We like to start clients on our courses on time frames. I trade off of volume and tick bars, and now I'm playing with using range bars. But for ETFs, we do. You know, ETFs, we absolutely trade the 5-minute and the 8-minute. Let's look at another day with kind of a weird, ugly trend off the ES 3-minute. And again, look for our key pivots. 20-period EMA, 20-period EMA, 20-period EMA, 20-period EMA, broke it during lunch. What do we see here? A Gartley, right? A, B, C correction during lunch. Both lows here, higher than this low. Huh. It happens all the time. It's ABC, this Gartley pattern during lunch. During lunch CME time. When I'm not trading, I never trade during lunch CME time. When this ABC concludes, it's right at the 50-period EMA. Uptrend resumes, and we get a bounce right off the 20-period EMA. Once again, these are wonderful tools that in any market you look at, any time frame you look at as far as intraday short-term trading, again and again and again, it's going to prove to be a wonderful method of recognizing a key area of support and resistance. And in the 5-minute time frame. So let's look at that last trend day on the ES. Or I'm sorry, not trend day, but the broken trend day, the reversal. And look at a TF 3-minute. Because the TF, which is the Russell 2000 futures, is a market that does trend well. It trends very well. So I'm going to scroll back. Here's what it looked like on the ES. A lot of big tails, a lot of choppiness. A little bit smoother on the TF 3-minute. A little bit different the way it behaves. Again, I actually didn't get along, so we didn't get a long signal from the TF. We get these key pivots. Where is it again? Right around the 3-minute, right around the 3-minute. Here are the trades. Actually, we did get a long signal. The trade signals that we had, long, short one after lunch, another short one late in the day. The TF, by the way, is in New York time because it's on ice. So you got 3 winners with this downtrend, all coming right off the 20-period EMA. 1 loser in the morning. Yeah, looks like a great setup. Looks like a strong uptrend to me. It happens. Fortunately, in the TF, it lost right away and didn't torture me. But let's see if there's a better way to look at this trend. And in our courses for futures, we start people on the 3 and 5-minute time frames. And then we're going to move to some alternative time frames. Because what are we not taking into account here? I have momentum. I have support and resistance. I have trend. What am I not taking into account here? Volume. Well, I've never found OBV to be very useful. Oh, my God, this guy yesterday was telling me, hey, you look at your 1, your 3, your 5-minute OBV. I'm going all in short today. I'm like, it doesn't make any sense to me. So he went short the market yesterday. We've been in longs with our end-of-day ETF service for a couple of weeks, and really finally busted up for us today. It's been a little torturous late in the summer. But I told him, I said, you're crazy to short the market out of the ECB tomorrow because I think we're going to have a 200-point up day in the Dow. Well, that's what happened. So, but, he was rambling on. I've never made a lot of sense out of volume. I do know that with, we trade stuff that has very high liquidity, the TNA, the UPRO, the UCO, SCO for ETFs. The TF, since moving to ICE, doesn't have great liquidity, so is there a way that I can incorporate volume into it? And so we like the TF in 233 tick, and that's a fib number. It's a really great time frame. The reason we prefer that our clients start in time frames in minutes is because it's easier to see stuff, and you've got to do a little more deciphering that we work with people on, and with technical indicators, because they're much more reactive, and you've got to learn where are these key pivots. Well, again, 20-period EMA. This is a risky trade because we technically haven't really broken that downtrend yet, but we do get a trade signal here. You do have the 20 cross, getting ready to cross under the 50. It's a little bit of anticipation, but once this trend has clearly established itself, key pivot, key pivot. Key pivots during lunch or kind of area of congestion. Key pivot when it comes up through the 20 at the 50. Key pivot right around the 20. Again, the 20-period EMA acting as a support and resistance area and giving me a lot of information about trend. So let's look at where we actually got trades here. Well, we got a long signal. What is that? The hidden divergence signal, a little too high over the EMA. I like to see it touch in futures. I'm only going to forgive it a tick or two. It's hard to tell on this, but that was about 10 ticks. Gartley, ABC, right into the 20 EMA, compound divergence down here. The hidden divergence signal, followed by the regular divergence signal, compound divergence, blast off. On the 233 tick, we get a hidden divergence signal way up here, too high over the EMA. So it goes to a higher high. Now we don't have the Gartley pattern. It comes back down. This is now a valid pivot. It's not the Gartley because price went to a higher high. This is a valid pivot that I did. It was too high over the EMA. Price comes back down. Now this trend is broken. We don't have a higher high. We have a lower high. And now we set a lower low. And now we have a lower high as well. Now we're looking for a trend reversal. We get a short signal here based on this hidden divergence. You can jam into it. That's a risky trade. If you're an aggressive trader, you can take that. Key pivot. We don't have a trade signal here. Key pivot, trade signal. Key pivot, 20 EMA, trade signal. Coming out of lunch, key pivot, 20 EMA, trade signal. Don't really want to take this one in the middle of lunch. Wait for the one coming out of lunch. Again, the ABC kind of Gartley pattern. Key pivot. Here we get another short signal here, little short signal here. So the 233 tick, now we're incorporating volume. Instead of just being locked down to time, I can see when we get into a congestion and we're not printing many bars, and we'll take a closer look at that in a minute, because the bars themselves are giving me the volume information. So now I am totally out of the range of multicollinearity, where I have a couple of trend and support and resistance indicators with my 20 and 50 EMA. I've got my stochastic for momentum, and now because I'm in a tick time frame, I'm letting the bars give me volume information, and I can tell how fast it's moving. All right. I like the NQ. I love trading the NQ. Here's the NQ 3-minute. Let's take another look at it. Is there a better way to trade it? Again, we're seeing support at the 20 and the 50 EMAs intraday, short time frame. So I always keep the 3-minute chart up. But is there a way to smooth out this trend? Another way is volume bars. What are called? In this, every bar is built instead of with the tick, with the actual volume. Long signal coming right off 20-period EMA. That beautiful hidden divergence. I get another long signal here. I don't take this because I'm a little confused by the noise, and this is something we want to talk. You know that that's why you don't see this in a 3-minute and 5-minute time frame the way you do in these volume and tick bars. So we like you to kind of get used to learning our stuff on time, and then you can move into volume and tick. But you know, if you're aggressive, you can take this knowing this is all noise in here. This is a key pivot. This is a key pivot. I forget that a lot on longs, not shorts. We get in lunch, and it's actually 12:01 here, so we don't take it. A hidden divergence signal. What happens again? The Gartley, right? ABC correction. Compound divergence coming out of lunch gets you back in with the trend. So that's the NQ 1597 volume bar. So they're giving me a little different look at the trend than that 3-minute bar is. A little bit smoother. Nicer rolling kind of movement, Still using the 20 and the 50 as our areas of support, though. And the other great thing about volume bars is, all right, this is an entire day. Look how many bars are being printed. This is a high volume day from a couple of months ago. This is from last week. All day. Red, green, doji, red, green, green. I'm not taking anything in this. One look at this. This is chop. These volume bars tell me right away. Look at the size of the tails here. I don't care what a momentum indicator says at this point. Look at what my moving average is doing. Jig-jag. You know, I call it saw teeth. We call it that in our courses, saw teeth. Indicators get saw teeth in them. That tells you you're in a choppy, horrible market. It takes an hour here to print, maybe 10 bars. And then when you get into lunch, you only get 3 or 4 bars in an hour. Okay, you can't trade that. You get a setup here coming out of lunch, right in the middle of lunch. You get another setup coming out of lunch. For me, this isn't worth trading. I don't care whether I make 2 or 3 points on the NQ. That's only going to be $50 or $60 per contract. I trade a lot of contracts, but it's like, that's not worth the risk to me. Where's my reward to risk ratio in here? And volume bars, tick bars give us one look. And I just decided to do this. It's funny, somebody asked me about range bars. It's going to be our next update to the courses. I've known a lot about range bars for a lot of years. I've read a lot about them. And this summer, I decided, I want to do something different. I'm going to trade range bars. This is 1.5 6-tick interval range bar, 1.5 point in TradeStation. In Ninja, this would just be a 6-tick range. This morning, right at the open, I got a long signal. And look at that. Beautiful. The range bars keep you in that. I'm finding that this setting worked great during the summer. Too noisy, so I may move to something more like a 1.75 7-tick interval, or an 8-tick. I'm going to run some back testing on that because we have kind of an automated version that we can run back testing on. But just looking at today, I also drew some fib extensions on there this morning. Got long again here. I got out of this way too soon because it got choppy, and this is where I'm realizing these particular range settings may be a little too choppy. And took one more long later in the day and kind of held it just into lunch and then got out. So the range bars, again, though, where are my key pivots, support and resistance occurring? Right around the 20-period EMA. And I put on Steve's 8-period EMA today. It was kind of actually using that to help me with exits a little bit, to stay with trades for a while. And I got to tell you, range bars did a nice job of capturing this move this morning. So that's kind of what I was doing today. I've never used Renko. Ted, I'm sorry, I don't know the first thing about Renko. I've never used it. John T., you can't see fry pan bottoms with range bars. I disagree. Isn't this a fry pan bottom today on this range bar? Wouldn't this been an intraday? From my understanding, which I just learned about fry pan bottom, this looks to me, I went long here and got caught in a little bit of chop. It wasn't very long, but this looks like isn't this kind of a fry pan? Yes or no? CJ, my blue is always 50 and my yellow is always. So anyway, that's a quick look at range bars. So anyway, wow, this worked out perfectly. As far as time, if anybody has any questions or I missed a question, go ahead and ask again. I'm kind of scrolling up. Question about the Gartley. The Gartley pattern is like an ABC correction. It's basically a way of looking at an ABC correction. It's primarily used more, and don't ask me where it comes in the Elliott wave count because I'm not an Elliott wave person. I'm not going to throw out my opinion of Elliott wave. I'm not a big fan of Elliott wave. The reason being, there's always an alternate count. If something always has an alternate count, then I don't want to mess with it. Don, as far as Forex, I didn't show any examples of Forex. We like the 5-minute, the 8-minute, and the 15-minute charts on Forex, and the 50-period EMA works incredibly well on Forex. The 20 EMA in a fast-moving trend. I trade in and out of the EC. We like the EC. I haven't been trading it recently because with everything going on in Europe and the euro, I just feel like it presents a little too much risk versus the reward. And it's been kind of flat and choppy and mired in that 125, 126 range. I just really kind of left it alone for the summer. Typically, a lot of currency traders I know don't like the EU or USD in the summer. I don't really particularly like the EC in the summer. I'll start looking at it again in the fall. Again, the red line indicator here on this chart, it's blue because in our ebook, it's a slow stochastic, slow K 533 or percent K, sorry, 533. So, all right, yes. Let me go back and explain a hidden divergence pattern, and it's right here in plain clear view. If the market is trending up, we have a high here. We have that's actually a terrible example because of the day it was. So I'm going to explain it for a long, let me find just you know what, ETFs, it's so easy to see the pattern in ETFs. And I always feel like if you're new to trading something, start off trading ETFs. They're great to trade. It's very simple to see the pattern. All right. When I have a trend, a higher high, a low, a higher low here, and my stochastic, my momentum indicator makes a lower low while price makes a higher low, that is a hidden divergence. And the analogy we use to describe hidden divergence, and that's primarily what I trade, is hidden and compound divergence all day, every day, is it's a slingshot. This is being pulled back like a slingshot farther than the point below. So while we make a higher low, the stochastic is going more deeply into oversold territory and springing for an upward explosion. 1597 is a Fibonacci number, Joey. And again, Betty, who's the founder of Right Angle Trading, is very big on Fib numbers, and a lot of traders are big. 233 tick is a very common time frame that people like to trade in the TF and in other markets because it's that Fib number. Bertha, percent K in a slow stoke is the same thing as percent D in a fast stoke, so it doesn't matter which you use. Flags and pennants. I don't pay a lot of attention, to be honest with you, to flags and pennants. Brian, Betty likes the William percentage R, which is based on a stochastic. She likes it. I don't use it. It's funny, we all have, we're primarily using, we use an RSI, but we primarily use the stochastic as our momentum indicator. I also like to have a CCI on there. Betty prefers to have the Williams R. I think that's, 533. Betty likes the percentage R. I am no expert in it, so I really can't comment on it. So I don't use it. So I just want to. I think we're about to wrap up here. Got just a couple more minutes. So I want to tell you what we have going on at Right Angle Trading. We actually are launching something new called the Trend Mastery Package. And it's our 2 trading courses in one big package. It's our Futures/Forex trading course and our ETF trading course that we've combined. You get live training webinars for both courses, live trading days with us in perpetuity, as long as you want to count our video library updates. And we're actually launching it tomorrow, and we're only launching it to Candlestick Forum, through Candlestick Forum, because we love Candlestick Forum. They're such great people. And this is kind of something new that we've never done before. We're just putting both our courses together, $2,000 value, selling it for under $500. I don't want to make a big sales pitch. You know what? Hopefully you guys learned something from today's presentation. I'll tell you a lot of what you saw today is what is in our trading courses. I kind of gave you the backbone of it, but there's a lot of little and some other indicators we use to help recognize trend, and especially to recognize exits and trailing stop strategies and things in that. Yeah, and then I'll go back. Let me finish what I'm saying, and then I'll go back and show that to you one more. The compound divergence thing, which is a big component of our courses. But go have a look around. If you're interested in how we're trading, I'm just a trend trader. And, when there's not a trend, I don't trade. I don't mind sitting out for a day or two. And then you get a choppy day, you get bored, you take a trade. You have an occasional losing day. But most of the times I'm going to make a lot of money on those big trend days. And on smaller trend days, I'm going to make a lot of money. And on those reversal days, I'm going to hit a loser, but then I'm going to hit winner after winner with a new trend. Every now and then, you're going to hit a day where, wow, I had a couple of losers. That's what I like about the NQ. At $5 a tick, I'm trading with $60 stop loss on 10 contracts. So, it's like $60 a contract. You make a mistake in the NQ. Geez, I made a mistake. Now I've got to go back and fix it. I got to get out of this trade. I wasn't paying attention. I was doing something else, and then I looked at the last second. I wasn't, disciplined. Every time you're not disciplined, every time I'm not disciplined, it costs me a tick. I've got to get out of this trade. It wasn't a signal. I'm not staying in here. I'm at least going to be disciplined in the fact that I'm getting out. Well, at the NQ, it's only $5 a tick. The TF is 10, the YM is 5, the YM trends very well. It's only $5 a tick. Something else I don't like about the ES. God, a mistake cost me $12.50. That's a lot of money to pay for a mistake. Same thing with slippage. Thank you, Stephen. I didn't know if I could do that or not. The stochastic setting is 533, and it's the percent K of the slow or percent D of the fast, whichever you like. So anyway, what we're doing is we're putting everything we do together into one big package with a ton of live training, a lot of live trading days coming up, our video library updates. We've been slow to get some important updates out to people who bought our futures course at the beginning of the summer. We kind of hit this thing where Betty was in chemotherapy for cancer treatment. She's now recovered, feeling a lot better, back to 100%. We're coming out of summer. We're hitting the floor hitting the ground with our feet running. We have some important updates coming out, and we really want to take people into these alternative time frames that I believe do a much better job of capturing the trend and keep us out of multicollinearity, because now we're incorporating tick and volume. That our next step is to for those who are interested is to move into range bars. And, we have a lot of fun. We love working with people, trading with people. I want to go back because, again, this is something that Betty and I just noticed time and time again, which is the compound divergence trade. And I've never seen anybody else notice this. And here is a perfect example of it. I get a hidden divergence. I have a higher low in price compared to here, while the stochastic makes a lower low, a big windup. I don't take that trade for two reasons. It's too far over my exponential moving average, which indicates this trend may be coming overextended. And it's also going into lunch. I don't want to sit during lunch. I want to go take a break, get my eyes off the market, clear my head. It's like why I don't trade oil. I'm in Los Angeles. I get up at 5:30 in the morning. I want to be awake, alert. I want to read the pre-market news. I want to be ready to trade when the market opens. Oil, unfortunately, you have to be trading at 5:30 in the morning. So I don't want to get up at 4:30. I'm a little bit lazy on that. So you don't take this hidden divergent signal. Now I get this ABC correction right back down into my 20 EMA, and I get a regular divergence, a slightly lower low in price, still above this last key pivot, and a higher high in my stochastic. So that is a regular basic divergence setup following a hidden divergence, and that's an incredibly powerful trade setup. And I never like to talk about winning percentages or anything like that because, everybody kind of looks at things a little differently. I'm going to tell you this trade setup is an incredibly powerful trade setup that you will see quite often as a trend continuation signal coming out of lunch. Sometimes you'll see it as after a morning consolidation and a continuation of the trend. And I'm going to say that 90% of these trades win, 80% to 90% of these trades win. and they shoot up in your direction. They are great trades. Does this work with daily and weekly, Gary? Absolutely. Will it work on individual stocks, equities? Absolutely. Glenn. I don't personally trade a lot of stocks. Betty does. She likes to, she's Canadian. She likes to trade those little junior miners and oil stocks and stuff like that. I don't have time to do the research on the stocks. So I'm trading futures and I'm trading ETFs. An ETF is just a big basket of stocks. Will it work on gold? Yes, it will. I don't trade gold futures. I would assume it worked on gold futures. I can look at them. I don't like to trade gold futures because so much of the move happens overnight. It happens while other markets are moving. But yet it works in gold ETFs. It works in silver ETFs. We're actively trading the HEQ ZSL. They kind of come in and out of play, Commodities kind of die in the summer. So we don't trade them a lot. We were trading oil over the summer. Oil was actually pretty good. We were trading the financials, the FAS, the FAZ, financial sector, and ETFs. We have a live trading room. Yes, we do. It's not every day. It's usually 4 or 5 days a month. And Glenn, I am not saying that the 20 EMA is a better support level than the 8 EMA. I am saying for what I'm trading, I like Steve's 8 EMA. The 20 isn't as great on dailies. On daily charts, we don't really use it. I'm talking about for short-term 3-5 minute tick settings, volume settings, these faster intraday trading time frames. The 20 EMA is giving me several pieces of information. It's telling me what the trend is doing. It's telling me where an area of key support or resistance. So I'm garnering 2 pieces of information out of one indicator, and that's why we like it. Is it better? There's no better or worse. There's different. There's different ways of looking at the market, of looking at trends. We all find what works for us and utilize it. And, I think these are things that work. I have always found that Steve's stuff and our stuff work very well in conjunction with one another. And I'm actually trying to incorporate, more of Steve's stuff into my trading and starting to look at it more. But, it's different. It's a different way of capturing the trend. And again, I'm a trend trader and I live for these kind of trend days. So with that, I am going to bid all adieu and really hope that you guys found this beneficial. One more time, the ABC, the Gartley pattern. So the market is trending up. It comes down and forms this hidden divergence too high over the EMA. Going into lunch, we expect consolidation. ABC, Gartley pattern, compound divergence coming out of. So I hope this was beneficial to everybody. And if you're interested in what we're doing, I would urge you to take advantage of this offer because it's going to be priced very, very cheaply. There's a catch to it. We're going to ask for a lot of feedback from you as a money back guarantee. You got nothing at risk there. And then we're going to do a much bigger launch of the Trend Mastery package later in the year at basically 4 times the price of what is going to be offered to you because of our wonderful relationship with Candlestick Forum. So let me once again thank Steve for having me in tonight. Thank you to everybody for coming. I know for anybody who's a Democrat, you might have been missing Obama. I thank you for taking the time out of your schedule and for coming. It's always a pleasure to do these with Candlestick Forum. I hope we all learned something. And, start looking at, for those of you who are intraday charting, traders, as Steve said last night, put it up on your chart. Don't take my word for it. Start looking at it on the chart. And if you're interested in what we're doing, we have this great special over the next couple of weeks. And it was a pleasure to be here. Is there an Obama indicator?
Brad, thank you very much. Once again, a very educational presentation. You can see that just from the interest everybody's expressing.
Yeah, and I'll tell you, Steve, I enjoyed learning about your ADMA because I was using it on my range bars today to help recognize some exits and kind of this. I guess this would be a fry pan, right? Where I got a signal to go long as well, and so I was trying to incorporate some of that today. So
exactly, and so this is what I tell everybody. You may not have the perfect trading solution for somebody. I may not have the perfect trading solution for somebody. But if you put the pieces together for your own trading style, you might be picking up good stuff from everybody and piecing it together to make your trading, your individual trading, all that much better. So, lots of good stuff here. I think everybody very much enjoyed it.
All right,
So
great.
with that,
Well, thanks for
everybody,
having me, Steve.
thank you, Brad. Thank you for the presentation. And we
All right.
will see everybody in the chat rooms. Thanks.